welcome to The Explainer. So, you're a founder. You've got the big idea, the drive, but let's be honest, US business taxes can feel like a total maze. Today, we're going to turn that maze into a straight-up roadmap for your journey. Look, we're going to skip the dense legal jargon. Instead, we're going to transform all those complicated rules into a clear story, something you can actually use. And we'll do that by breaking it down into the 4 key stages that pretty much every single business owner has to face.
So here's the plan. We'll kick things off with choosing your business's identity. Then we'll get into the nitty-gritty of daily operations. After that, we'll talk about deducting your expenses, the fun part, right? And we'll wrap it all up by looking at how your profits and even your losses are taxed.
All right, let's jump right into section 1. And I can't stress this enough. This first stage is so crucial. Choosing your business entity, it's not just some legal box you have to check. No way. It's maybe the biggest tax decision you'll make, and it's going to shape your company's entire future. Okay, so what you're looking at here are the fundamental trade-offs every single founder has to weigh. Think of it like a spectrum. On one end, you've got the sole proprietorship. It's super simple to start, but, and this is a big but, you have unlimited personal liability. Not great. On the other end, you've got S Corps and C Corps. They give you that limited liability, which is awesome, but the real game changer is how the money gets taxed. With an S Corp, it's pass-through. The profits literally pass through the business right onto your personal tax return. But a C Corp, that gets taxed at the business level first, which sets up that infamous double taxation. And this right here, this quote nails it. It explains exactly why the LLC, the limited liability company, has become just dominant. It really is the chameleon of the business world. Why? Because it has this incredible flexibility. An LLC could choose to be taxed like a sole proprietorship or a partnership or even a corporation. So you get the best of both worlds, that crucial liability protection, but with the tax flexibility of these simpler structures. It's a real win-win for a lot of founders. Okay, so you've chosen your identity. Now what? Well, now you're in business, and the daily rhythm of actually running things, making sales, managing your money, hiring people, that all creates a whole new set of tax obligations you've got to stay on top of. So one of the first things you have to figure out is, how are you going to track your money? This choice between the cash method and the accrual method is absolutely fundamental. The cash method is pretty intuitive. It's basically like your bank account. You record income when the cash actually hits your account, and you record expenses when you actually pay them. Simple. But once you start getting bigger, specifically when your gross receipts go over $29 million, the IRS says, nope, time to grow up. You're now required to use the accrual method. This way, you're recording income when you earn it, not when you get paid, and expenses when you incur them. It just gives a much truer picture of a big company's financial health. The moment you hire your very first employee, congratulations, by the way, you get introduced to a whole new world of taxes. Meet FUTA, the Federal Unemployment Tax. And here's the kicker. Unlike other payroll taxes where you and the employees split the tax, this one, it's all on you. The employer pays 100% of it. It's basically how the federal government chips in to fund state unemployment programs. At first glance, this seems pretty manageable. The tax is only paid on the first $7,000 an employee earns each year. But as you can probably guess, there's a little twist. And here is that twist. High employee turnover can create this nasty compounding effect. See that $7,000 wage base? It's tied to the employee, not the position. So if someone leaves and you hire a replacement, boom, the clock resets. You start paying FUTA tax all over again on the new person's first $7,000. So for one single job, if you have 3 different employees in a year, you're paying that tax 3 separate times. Ouch. Okay, this leads us to something you absolutely positively need to get right. We're talking about one of the most severe penalties in the entire tax code. If you withhold taxes from an employee's paycheck but then fail to send that money to the IRS, the penalty is a whopping 100% of the unpaid amount. And here's why it's so terrifying. The IRS sees that money as being held in trust for them. It was never your money to begin with. So if you don't hand it over, they can actually pierce the corporate veil, go right through your liability protection, and hold you personally responsible for all of it. All right, enough of the scary stuff. Let's move on to something a little more empowering, making your spending work for you. We're talking about how you can legally lower your tax bill by deducting all those ordinary and necessary business expenses. Let's start with a classic, business meals. Whether you're taking a client out to dinner or you're eating while traveling for work, the general rule is pretty simple. You can only deduct 50% of the total cost. And yeah, that includes the tax and the tip. So if you spend $100 on that client dinner, even if it was totally legit for business, you can only write off $50. Now, sure, there are a few exceptions, but for the most part, just remember, 50%. Now, what about the home office? For years, this was a huge pain to calculate, but now there's a simplified method, and honestly, it's a lifesaver. It's so easy. Step 1, measure the part of your home you use exclusively for business. Step 2, multiply that square footage by $5. Step 3, that's it. That's your deduction for the year. It's capped, but it saves you from the massive headache of tracking the business percentage of all your utility bills, your insurance, repairs, everything. And here's a really fantastic benefit of going the simplified route. You can still deduct all of your mortgage interest and property taxes on your personal tax return on Schedule A. This is huge, because if you used the old traditional method, you'd have to chop up those expenses, allocating a piece to your business, which would then reduce your personal deduction. So using the simplified method can be a really significant advantage. Okay, we've come to our final section, the bottom line. Let's talk about how the tax system ultimately treats your company's profits and, because it happens, its losses too. All right, let's unpack that double taxation thing we mentioned earlier with C corporations. It's really a two-step process. First, the corporation itself earns a profit and bam, it pays corporate income tax on it. Then, whatever is left over, the after-tax profit, gets distributed to shareholders as dividends. And bam, the shareholders have to pay personal income tax on that exact same money all over again. One pile of profit, taxed twice. Now, this is in stark contrast to pass-through entities like S-corps and partnerships. Remember those? With a pass-through entity, the business itself pays zero income tax. Instead, all the profits, and losses for that matter, just flow directly or pass through to the owner's personal tax returns. This structure completely sidesteps that first layer of corporate tax. But what happens if you have a tough year? What if your deductions are actually more than your income? Well, that's called a net operating loss, or an NOL. And you shouldn't just think of it as a bad year. From a tax perspective, it's actually a powerful tool. An NOL isn't just a loss on paper. It becomes a real tax asset that you can use down the road. So how does it work? Well, you can take that loss and carry it forward to reduce your taxable income in future, more profitable years. There is a catch, of course. The deduction is limited to 80% of your taxable income in that future year. So if you make $1 million in profit, you can use your past losses to wipe out up to $800,000 of it. But here's the really good news. You can keep carrying the rest of that loss forward indefinitely until you've used every last penny of it. So when you step back and look at it all, what do you see? Every tax form, every choice you make, it tells a story. And understanding these foundational tax concepts means you get to be the author of your business's financial story. It's about more than just compliance, more than just following the rules. It's about making smart, strategic decisions right from day one and writing the best possible story for your business you can.